All right. Good afternoon, everybody. Welcome to another world famous self-directed IRA Saturday with the voice of IRA education, Quest Trust Company. My name is Kurt Power. I'm one of the certified IRA specialists with Quest Trust out of our Houston office. Very, very excited about today's presentation. We're going to be talking with Ryan Gibson, CIO of Spartan Investment Group, talking all things self-storage and why this might be the best asset class that you're not already investing in. But before we get started, quick little history. If you're new to Quest, who are we? We're the largest self-directed IRA custodian in the great state of Texas and the fastest growing in the United States, with over 20,000 active investor clients across the United States. Presently over $2 billion in assets under administration, over 100 employees across our Houston, Dallas, Austin offices, and 34 of those hold the prestigious Certified IRA Services Professional designation. And in any given time, we can have anywhere from $400 to $450 million in undirected cash. So if you're looking for money for deals, this is a great way to access capital in the form of other people's IRAs. But a quick disclaimer, everything that we do at Quest Trust Company is for your education. We highly encourage you to understand we don't give any tax, legal investment advice, but we encourage you to do your due diligence, both on any potential investments that you're looking at doing, as well as any people that you're potentially going to be doing business with. Starting on Monday, we're very excited to announce this promotion for 1 week. We will be giving you $100 credit to your account for any account that you open. This is truly unlimited, so this is a great time if you don't have a Roth IRA, a health savings account, maybe a covered education account for the kids. Open those accounts. We will give you $100 credit for doing so starting on Monday. So reach out to us at IRA specialists at questtrust.com. I've also got one of our best IRA specialists working with us today in the chat, Mr. Zach Wilson. He is more than happy to answer any questions that you have and set up any consultations for you and your family. Use us as a resource for education, guys. Every Tuesday at noon, we hold weekly classes. Every fourth Wednesday, we hold virtual networking happy hours with investors all across the United States. And of course, self-directed Saturdays every single Saturday at 12 noon. If you happen to miss any of the presentations that we give, fear not, they are archived to our YouTube channel. So if you miss anything, any presentation that you wanted to go to and miss, always go back to YouTube. They're there for your benefit and your education. We're going back slowly integrating our in-person events. So self-directed IRA socials, the first Tuesday of every month in Houston, the second Tuesday in Austin, third Tuesday in Dallas, all starting at 6:30 p.m. Come network in person, increase your network, increase your education, and have a great time. San Antonio, we're coming for you. March 24th at the San Antonio Norris Conference Center. We'll be hosting our first of what we will have many lunch and learns in the San Antonio area. Guys, if you're not familiar with San Antonio, this is one of the booming markets in the United States. So we're very excited to increase our footprint across Texas and entering into San Antonio. About 30 calls a week as an average of average IRA specialists across all of our offices. We get 30 calls a week minimum about cryptocurrency. You guys have asked for it. We're listening. April 5th, this is what you want to mark your calendars. April 5th at our Houston office at 6:30, we're going to have the Chief Commercial Officer of ErisX, Mr. John Denza, giving a presentation about how you can utilize your Quest IRA to now purchase cryptocurrency. If you can't make it to Houston, don't worry. We're streaming it live on Zoom. So anywhere in the country, you can log in. Make sure you do not miss this. This is going to be a game changer, not only for Quest, but also for further diversification inside of your retirement account. But of course, the main event, the icon of events that we do, the third annual Quest Expo. First time since 2019, due to the pandemic, we are bringing this back in Houston, September 23rd to the 25th at the Westin in the Galleria. If you've never been to the Quest Expo, I highly encourage you to do so. If you have been to the Quest Expo, then you already know what it's about. It is the top self-directed IRA event anywhere in the world. We will have 3 days of education across all asset classes. Important thing to keep in mind. Yes, we're a self-directed IRA custodian. We preach using self-directed IRAs. But be diverse in your investments. Don't think that this is just for IRA investors. This is for investors of all kinds, all experience levels. Whether you use your IRA or use your own liquid cash, you can get something out of being at the Quest Expo. Zach will put the link in the chat so that you can register for your tickets. They are never going to be cheaper than they are today. So part of an overall wealth building strategy is saving money. Get your tickets now while they're as cheap as they are. Highly encourage you to be there. How do you get in touch with an IRA specialist? Very easy. You can chat with us, any of the IRA specialists, during business hours, Monday through Friday. We are live on the website answering your questions in real time. You can old school, pick up the phone, call us, 855-FUN-IRAs. Or you can email me directly, kurt.power@questtrust.com. You can talk to any of the IRA specialists by sending an email to iraspecialists@questtrust.com. So that's all for me. I'm going to add to the presentation now our guest speaker, CIO of Spartan Investment Groups, Mr. Ryan Gibson. Ryan, how you doing, man?
Good, Kurt. Thanks for having me, and it was really great seeing you at the self-storage conference in Orlando this past week.
Absolutely.
And also in Denver.
Yeah, I was going to say, man, I've seen you more in 2 weeks than I've seen you in 2 years. It's always good to hear from you. And, you and I, we met. I used to be in self-storage. That's how we met. And when I came to Quest, I think you were the first person I called to say, hey, how can we continue working together? Because Spartan, in my opinion, is one of the very, very best in the space. What you guys have done is incredible. And I know that, we spent some time at the national conference in Orlando. So looking forward to you kind of giving us the 411 on self-storage and why this is maybe the best asset class that people aren't investing in.
Yeah, well, certainly we saw at the self-storage conference, record attendance, a packed room with people, a lot of capital getting into the space. We saw KKR, for example, was on stage with me talking about their acquisition strategy for the year of 2022 and how much they plan to invest in the space. And, it was a record year this past year for storage. And I think that trend is going to continue. And we'll kind of talk about that a little bit more in today's discussion. But just wanted to thank you guys and everybody at Quest. You guys do a phenomenal job setting up IRA accounts for our investors. And we really appreciate all the good education that you guys provide the industry. So
without further ado, man, I'm going to stop flapping my gums. I'm going to remove myself, and I'll be in the chat. Zach will be in the chat. When at the conclusion of this, we'll answer the questions that you guys have. So,
yeah, absolutely. And we'll have questions. We'll have time for questions at the end. So for those that are just never heard of self-storage, one thing that I think is interesting is that 1 in every 10 Americans uses self-storage. And of those Americans, 66% of them have a garage. So self-storage has really become a tool. And a lot of people say, is it just because Americans have too much stuff? And the reality is we have about 60,000 self-storage facilities in the United States. And it's become a convenience item for a lot of businesses, sports teams, contractors, and people looking to increase their space. And during COVID, we really saw the narrative of self-storage play out and get stronger. We're going to talk about that. And the reason why people use self-storage today is for one reason, and that is life events. People age out, they relocate, they hit the road in their RV and put all their stuff in storage. They get hit by a national global pandemic that allows them to work from home. Now they need to free up that space in their house, so they put their stuff in storage. Or they're like me and they have a renovation because I have a growing family, which is a life event, and I've got to move all my stuff out of my house while I do a renovation to make the house more accommodating to my growing family. So it's one thing that is a driver of self-storage is life events. And during COVID, when we saw eviction moratoriums, we saw government shutdowns, we saw restrictions on rent increases, storage wasn't participatory in any of that. Spartan was raising rents, and a lot of self-storage companies were raising rents throughout the pandemic. And in fact, we had a record year for rental increases, and we had a record year for occupancy. There's some data that came out post-pandemic on the performance of the asset classes at the publicly traded REIT level. And self-storage was the least challenged by COVID-19, growing 71.69% and leading the entire industry throughout the global pandemic. And I think this really kind of just goes to show that self-storage proved out its recession-resistant tendency when you have a big disruption in the economy. So if you're thinking that the market's going to crash, or if you're thinking that the war is going to continue to put pressure on the United States, to inflation is going to keep going up, things like that, have no fear with self-storage. It has proven itself out over and over and over again during the most trying times. And this is just kind of a look at the last 4 recessions. You can see those big troughs in the blue lines, and the gold lines is self-storage occupancy. And you can see that during all of the slowdowns in GDP growth, self-storage occupancy remained consistent throughout the last 4 slowdowns in our history, dating back into the 80s. And this is an interesting chart that we put together that kind of combines Marcus and Millichap, the NREIT data, the Standard & Poor's Index, and it gives you a look at how self-storage was doing prior to the global pandemic and while the economy was kind of ramping up. And you can see the green line there, self-storage performs consistently well during good times and in bad, as I just mentioned, and it was actually performing 300% more than all other REITs in the S&P 500 during the last recession. So, we're not a REIT. We don't sell, our shares like a REIT does. But REITs are a great bet. Self-storage REITs are a great bet in your portfolio, and then obviously, investing individually in self-storage on your own or with another operator. So what happened during COVID? A lot. It was one of the most action-packed, volume-packed years for self-storage. Specifically, dating back just about a year ago, Public Storage picked up a $1.5 billion portfolio in Dallas. Then they picked up a $1.8 billion portfolio in the DMV area, DC, Maryland, and Virginia. Blackstone jumped into the game. They bought Simply Self Storage for $1.2 billion. They really wanted to have an opco or an operating platform. So they bought the self-storage brand Simply, and then they bought all the underlying assets. And then Bill Gates jumped in during the pandemic and became one of the largest owners, one of the largest storage operators, StorMart, in the United States. And then we had Inland Private Capital monetize a $265 million portfolio, and then Simply went on another buying spree right there where you guys are in Houston, and they picked up another just shy of 10,000 doors. And then CubeSmart recently acquired another self-storage portfolio for $1.69 billion. And right around that time, the Wall Street Journal was really picking up on it and declared self-storage as the pandemic's hottest property. And last year, Spartan Investment Group, we picked up about $270 million. This is a press release just prior to the end of the year, announcing that we purchased $200 million. But kind of transitioning to kind of who we are and what we do, Spartan Investment Group is based in Golden, Colorado. Last year, we were the Inc. magazine rated 5th fastest growing private real estate company in the United States, and 166th fastest growing company overall. And we operate all of our facilities under the Free Up Storage national brand. So we started Free Up as our operating company for the self-storage line of business, and Spartan is the overall investment group. And what we do is we do a little bit of everything. So we go out and find opportunities to purchase. We work with our capital markets team that's in-house to secure the debt. We raise money from individual retail investors. And then we have a construction company inside of Spartan that builds our units and expands our properties and does all the initial improvements. We do the asset management, overseeing the revenue and portfolio-wide management of revenue. And then we also do the property management. So we're hiring all the store managers, we're hiring all the regionals, districts to run the Free Up Storage national brand. So kind of looking back, this is our year in review. We picked up about $260 million of self-storage facilities, increased our staff by 73 new headcount, added about 15,000 doors to our portfolio, and broke ground on about 22 construction projects across the United States for our platform. But this is Scott and I. We co-founded the business back in 2013. Scott is a military. He's an Army vet, served in Iraqi freedom, and we met in Washington, D.C., and we really just had one thing in common. We wanted to build a great company capable of building leaders and helping people have freedom and responsibility in the corporate workplace. And the one thing that we started right away was we really got clear on what our values were and why we started the business. And our values are defined by our grit, which is growth, respect, integrity, tenacity, and transparency. So everything that we do, everybody that we touch, we apply the values to all aspects of the business, whether working with a seller, an investor, a buyer, whatever it might be. This is a little bit about our portfolio. We have about 54 stores, or about 20,000 units spread across the United States. Primarily, we're in Texas. We're in the DFW Metroplex and in East Texas. We also have one property there just north of you guys in Huntsville, Texas, just north of Houston. And then we have some assets in Tennessee, Georgia, and Florida, primarily. So kind of looking back to 2021 so that we can understand where we're going to be this year, we picked up some prized assets, some Class A facilities, multi-story glass, really nice climate-controlled properties. That one there in Cumberland, that's actually in Tyler, Texas, off Broadway Street. And then the top two there are in Madison, Wisconsin. We picked up a couple of Class A assets there. And then the two pictures there, you'll see that's actually a facility that we built just south of Seattle, Washington. And that's about 110,000 square feet. We also picked up some value add. So these are kind of like C and B vintage properties where we'll take the facility and move it up a full letter grade by putting paint on it, paving the drive aisles, putting in cameras, software, and revenue management. So the picture bottom left there, that's in Georgia, just outside of Atlanta. And then the two at the bottom there are part of the DFW portfolio that we picked up in late Q4 of last year. So let's get into what happened. I think this is a really cool thing. This was put together by Newmark. And we actually had the guy from Newmark come in and brief our company on what was going on. This guy has done already this year over 300 self-storage appraisals in 2022. So he knows what's going on. He knows what things are trading for. And I think what's interesting is if you look at the top line there, you can see Q3 2021, what the average cap rates were for apartments, multifamily, versus self-storage. So if you're wondering, kind of how does self-storage compare cap rate wise to apartment investing versus self-storage investing, you can see the spread, which is 24 basis points. So less than 0.25% is what the spread is on cap rate, which ultimately determines your value of the facility. You might be thinking, man, I know this is crazy, 4.93% cap rate. Who is paying that kind of cap rate on a portfolio? This is kind of a high quality assets in strong markets that we typically operate in. This isn't your like 30 unit facility in the middle of New Mexico, for example. This is kind of high quality assets within an hour of a major airport. And what's interesting, if you look down at the bottom, look all the way down here to Q2 2010, you can see cap rates 7.85%, 8.45% for storage. The spread has been pretty consistent throughout the years, but you can see that cap rates have compressed significantly in both apartments and self-storage, and they sort of follow the trend together. So cap rate compression, this is actually looking at actual sales of large and mid-sized portfolios. And I wanted to point there at the bottom right, 2015, you can see, again, you can see pro forma cap rate and then TTM. TTM means trailing 12, trailing 12 monthly cap rate. So that's like actual performance. So when a value of a property goes for sale, a trailing 12 is usually a better indicator of what you're paying on a going in cap rate. And you can see that 4.85% was kind of on the low, 5.5 at the high. And compare that to 2021, you can see that cap rates have compressed below 4% on the low end, and on the high end, you can see cap rates are 5.5 to 4.9%. So really, we're looking at portfolios this year. We're expecting self-storage to trade in the 4.25 to 5.25 cap rate range. And what's interesting, in the last 2 quarters of 21, we saw cap rates compress in self-storage by 85 basis points. And I don't know if you guys have been, watching self-storage over the years or any type of multifamily or real estate investing, but that is crazy. That is a lot of cap rate compression, and it's kind of indicative of all of the capital that's coming into the space. I kind of reflect back on what it was like, even when I started in self-storage in like 2015, 2016, you would call lenders and lenders would be like, I don't know, I'm not really that familiar with self-storage, or, we don't really lend on self-storage. And I think what's really accelerated is a lot of lenders are jumping into the space. They're seeing it as a flight to safety for a very secured loan, and more and more banks are opening up their checkbooks, and it's causing more money to go into the space. And compare that to the Blackstones of the world and the publicly traded REITs that are getting into the space, where typically KKR was mostly just kind of multifamily, single family, and everything else. They didn't have self-storage in their portfolio, and they've added quite a significant number of facilities just in May of last year, and they have plans to continue picking up. So that's really kind of pushed down cap rates. The other things that I wanted to kind of point out is large portfolios tend to trade below 4% cap rate, which is pretty significant. And what's going on with construction? If you asked me in 2015, what's your biggest fear about self-storage investing? I would say new supply, because if you looked at the charts in 2015, 2016, the industry was exploding. There was new self-storage going in all over the United States. They were building it on every single corner, and everybody feared going into a market and then having a bigger, nicer competitor build right down the road and saturate your demand. Right? But look what happened. I mean, in 2017 to 2019, we saw a significant drop off of new starts. And, one thing that's kind of interesting is, our underwriting team would look at building a new facility. If you had $7 to $10 rents, that means that the average unit in your facility, a 10 by 10, would rent for about $80 a month. That's what you would need at least to be able to justify construction, right? Well, now construction costs are through the roof. We have supply chain issues, we have inflation, we have labor shortages, we have escalating steel prices, we had all these things happen in COVID. We had banks pull back from lending on new construction, and we had, quite frankly, had a lot of projects just stop. But one of the biggest things that's interesting is those construction costs killed a lot of projects. And the reason why they did that was because now, in order to build and make a project pencil, you would have to see $12 to $16 annual rents per square foot, or about $130 per month for a 10 by 10 to build. So those numbers aren't going down anytime soon. So what you'll see now is, if you're in a self-storage that exists or that's built, there's a low likelihood that there's going to be a competitor that builds down the street, because the cost of construction is just so high, and it won't pencil if it's not these higher per square foot rents. And I would even argue, $16 per year is probably the minimum. So you can see we're trending down, and now we're kind of got a tailwind with decreasing inventory, and now more money chasing fewer products. Another issue, another benefit, and the reason why a lot of investors are getting into the space is scale and automation. So technology doesn't scale very well in prop tech typically. You can implement a lot of automation at your multifamily or your single family, but really the benefits are just sort of very infinite with self-storage and getting kiosks and call centers and automated move-in and move-outs. And it's really accelerated the industry, and it's allowed operators to reduce their expenses and thereby increasing their NOI and their overall valuation. They don't have to rely on the employees that are few and far between these days, because they have automation being implemented at their facilities. So this is just kind of a zoom in on our Georgia facilities and a zoom in on our Texas facilities. And as you can see, we operate quite a bit of facilities, and you can see they're all kind of clustered. And what we like about that is we cluster our properties together so that we can reduce payroll and have maybe one area manager look over multiple facilities. That's what you're going to continue to see this year. The REITs have a stated goal of reducing their payroll by 20% this year. So they're going to continue looking for product that allows them to do that. So they're looking for scale in different markets. So, obviously, well-located properties and good fundamentals this year is going to continue to play out in acquisitions. People are going to be looking for economies of scale. They're going to be looking at focus in high-growth markets where the population is going. People are going to, like I said earlier, going to really look for that economies of scale. That's going to help with cap rate compression. That's going to help with NOI growth. And then that overall, investors are chasing yield, and they're looking for properties in secondary and tertiary markets more than primary markets. Sure, there's a lot of investment in primary markets, But really, a lot of the yield that you're going to see this year in self-storage is going to come out of the tertiary markets. So for example, look at Atlanta. We're not in Atlanta. That's the primary market. We're down in Columbus. We're over in Macon. We're up towards Dahlonega. We're up north on the Georgia border towards Chattanooga. Those secondary, tertiary markets, more tertiary markets, are where the yield is going to happen and where the population is going. So pretty amazing. We ended 2021, or basically the global pandemic, with 12.7% year over year rent growth. And, that's just, it was a phenomenal year. So what's going to happen in 2022? We talked about it a little bit, but my predictions are continued cap rate compression. The 10-year Treasury is really going to, tends to follow cap rates. So if that continues to go up, we might see cap rates go up. But the reality is the amount of capital coming into the space, the new players that Kurt and I both saw at the conference, a lot of new big money in the space. And as everybody knows, cap rate is nothing more than a reflection of your risk assessment on a deal. Interest rates may be creeping up, but a lot of these bigger companies are paying all cash. It's a flight to safety. It's to put their money in something that is going to continue to produce if we have an economic disruption. I think we're going to see interest rate increases. So you're going to see probably, I think the Fed is going to announce an interest rate increase of either 25 or 50 bips next week or the week after. I can't remember when they're meeting, but and then we're probably going to see 1 or 2 more interest rate increases this year in the market. I think we're going to see continued inflation at least through the end of 2022 as suppliers get their value chain in order, as chips come to build cars and whatever it might be. I think we're going to see continued inflation, probably close to double digit, at least actually, but maybe measured, continued in the 7 to 8% range as previously announced. And we're going to see slowdowns on projects. We're going to see some construction projects come to market, but we're not going to see a lot of new construction starts for self-storage, keeping the competition at bay and the markets in a good position to raise rents and do continued revenue growth on a more limited supply of self-storage in each given market. We're going to see increased buying competition this year. We're going to see, it was kind of interesting. We usually, when we do a call for offers to buy a new property, we look at about 1,300 to 1,400 properties a year, and we'll buy anywhere from 20 to 50 properties in a given year. So we really look at and bid at a lot. Last year, we would see about 5 to 8 offers come in on a facility. Now we're seeing 17 to 25. So there's increased buying competition. People are getting more warmed up to the asset class. It's growing up. So you've really got to have a fast capital stack and a really good team and a very well networked acquisitions team that knows the brokers and kind of knows where to play in the market, and a good off-market strategy. So you're going to see a lot of increased buyers at the table. So expect that. We use, in order to kind of underwrite our projections for 2022 going in on an investment, we use REIT data, past historical REIT data. They publish that information. We use industry data, and we use kind of actuals, and we actually do a measure of household income and how much a person can pay for a given storage facility when we're going through an underwriting. But we see anywhere between 7 to 11% revenue growth in storage. That's how we're underwriting this year. Obviously, it all depends on the asset and where it's located, and et cetera, but that's what we're planning on. And we're seeing our expenses increase 2 to 5%. You're going to see expenses grow in 2 primary areas: your payroll, and you're going to see it grow in your property taxes. A lot of markets, property insurance is going up as well, but those are kind of the 2 areas that we're going to predict that expenses are going to increase. Yes, we're decreasing our staff, but also that staff that you get is more expensive. So we're kind of seeing a net expense growth in payroll and in property taxes. So what does successful investing look like in 2022? What are some of the predictions? Invest in hard assets: land, multifamily, storage, things that can hedge inflation. Hard assets tend to do that. And what I love, if there's one takeaway that you can take from this presentation, long-term fixed rate debt and assets that have short-term adjustable leases. And what I mean by this is something that's elastic, something where your tenant moves in and you can change the rent within a short period of time. So for example, self-storage, we can increase the rents every 30 days. So we know fixed rate debt or debt and interest rates are going to be increasing this year. We know that. That's been announced. It's been pretty clear and pretty made, it's been announced far and wide. So we put long-term fixed rate debt on our facilities, and a self-storage lease renews every 30 days. So we can keep up with the consumer price index. When rents go up, we can go up. When other costs go up, we can adjust our rates, which is what we did throughout COVID and what we plan to do this year. So if you're looking at real estate and you're thinking, okay, what's the best type of real estate that I can get into this year? I would say that multifamily, industrial, and self-storage are my top selections for 2022. Last year, I think I did this, and I said my top picks for 2021 were mobile home parks and storage. I think multifamily and industrial, obviously industrial is picking up space. There's a higher need for it, last mile, closer in. There's a lot of industrial flex that's getting a lot of popularity and investors into the space, or multi-tenant industrial. And then multifamily, I think, yes, the leases are 1 year, but I think we're going to still continue to see an uptick in multifamily rents as those rates become able to adjust. So I wanted to kind of take a pause and just kind of talk about, a case study. I love doing case studies. I love talking about, a real self-storage property. I specifically love talking about a property that we've purchased. This property in particular, we purchased almost 3 years ago now. This is just south of Dallas. It's in Corsicana, Texas. We picked it up for $6 million. And I really like this because we can get right into the cap rate. So there was $443,000 a year in NOI when we bought that. So our going in cap rate was a 7.38% interest or cap rate. So you're probably thinking, holy cow, that cap rate has compressed, probably 150 to 250 basis points since we purchased the asset. So this asset has increased in value, not because of our great operations, or not only because of our great operations and the expansion that we did that we'll talk about, but also the amount of money going into storage has really pushed down the cap rate on this asset. So again, we bought it about 3 years ago. Came with a car wash, came with 2 acres of vacant land to expand, and it also came with a U-Haul truck rental business that we could monetize. This is a little video of the property. This is the existing facility that we had some drive-up units, some interior climate controlled. It had U-Haul in the front, and it was about 735 units, and it was 98% full. 81,000 net rentable square feet. This is the interior space that had some climate control. There was a couple buildings that way. Had the car wash that we ended up kind of spinning off and selling. Actually, we subdivided the parcel and sold off the car wash, returning capital a little bit earlier. And then, our customers love U-Hauls. We don't really do the management of the U-Hauls, but so this is the vacant land I wanted to talk about. 2 acres, and we took this land, and you can see we built 2 extra buildings on it. About 40,000 square feet, or about 238 units. This is our construction team that's out at the property on the construction camera, and you can see they did the time lapse here of the construction of the units. Some of those units were exterior drive-up units, and then we added. You can see the buildings are a little bit wider. There's an interior corridor on the inside here where you can see that we have air-conditioned units as well. So it was a really good project. We actually there we are cutting the ribbon with Navarro County and the Chamber of Commerce. We do that to kind of get the word out on the new buildings that are coming in to kind of generate some hype around the facility. And so overall good project. And people always ask, well, who's your lender and how, how much equity, how much debt, what do you typically do? So this is sort of how it works. We put together $2.3 million of private equity. That's investor capital. That's self-directed IRAs, cash, whatever it might be. And then we actually went to the bank next door on this one, Community National Bank of Texas, and secured $5.2 million of debt. So overall, we had $7.5 million to play with. And here's how we spent it. We bought the property for $6 million. We used $1 million of that to expand the facility. We had about $250,000 that we put aside for a rainy day. And we have about $250,000 of project management fees, closing costs, and other expenses. When we put this under contract, 60 days due diligence, $60,000 earnest money deposit. This is kind of funny. Our due diligence on properties now, we've refined it. The market has heated up. It's been a necessity. We actually start due diligence before we even get it under contract now. We kind of risk ordering the studies and the environmentals. It's kind of like residential now, where you sort of get your pre-inspection, so you kind of have that going in, knowing that the property is in good shape. Our due diligence period, though, now is 30 days, and we usually close 5 to 15 days thereafter. That's kind of how fast this product is moving now. But back then, 60-day due diligence. I just kind of laugh when I see that, because the industry has changed so much. Competitive analysis. We door knocked on every property. We looked at data, and our property was about 98% occupied, but there was 83% economic occupancy, meaning that we could raise rents, we could collect on tenants that weren't paying, we could increase our street rates, and all those other things that build value in self-storage. And when you look at a property, you want to try to find in the rent roll opportunities. So if you look at this rent roll, this gives you all the 5x5s, 5x10s, 10x10s, etc. And we found that there was a big gap between what the tenants were actually paying and what the street rates were. And so you could see, about 47 of these tenants were paying about $47 a month, about 67 tenants. And we're like, wow, that's a lot when you consider that all these other customers are paying way below that. So you can see we had tenants paying $23, $24. We had 9 people paying $33, almost half of what the majority of people were paying for that unit type. So what we did was we went through the whole rent roll and we added up, okay, what's the gap between what we're charging at the front door and what the actual tenants in the facility are paying? And we found that we could increase rents $165,000 just by charging everybody the same rent. And what we decided to do is we said, well, we're going to conservatively underwrite just increasing rents about $72,000 a year, and we're going to give ourselves 18 months to do that. And what that does is it increases your cash flow $6,000 a month. And if you divide by a cap rate, that adds about $1 million in value. We didn't fix anything up. We didn't do anything. Just simply bringing the rents to what everybody's charging adds $1 million of value to the facility, which is pretty incredible. The next thing we did was we said, okay, we have this 2 acres, and we've got to figure out how to lay it out. What setbacks, what restrictions, what easements are on the property, if any. So we got a civil engineer to do that. And we figured out that there was about just shy of 40,000 square feet possible. And if you can see that bottom right-hand pick there, you can see there's a big gas line easement going to the property. So the civil engineer said, okay, you can't build there. And then you can see on the left-hand top, there's a little proposed retention pond. And, you can't build there because you need stormwater control. So they figured out, okay, you've got about 40,000 square feet of buildings you can put on the plat. So again, highly recommend you go to a civil engineer before you assume that you can just build everything on the property. But we said, we're not really sure if we're going to build 40,000. We'll just underwrite and project building 20. And at the time, it was about a 6-month timeline to build, about $1 million to build it, about $50 a square foot. And then we gave ourselves 15 months thereafter to lease it up. Overall, adding about $2.34 million of value. So great investment. Put in $1 million, get $2.34 million of value in the expansion. Now you're probably thinking, okay, $1 million at 20,000 square feet, it costs you $50 a square foot to build this property. So what actually happened in 2020 when we started construction, we ended up coming in at $42 a square foot. This was a very basic, easy entry-level site. That same cost today would be about $72 a foot. Just to kind of give you an idea, we're building thousands of units every year. So this same site would almost literally have doubled in cost due to inflation and supply chain issues. So here's some things that we do. We rebrand to our Free Up Storage national brand. This is how we add value to storage. In multifamily, you may take a bunch of units offline, put in new kitchen packages, increase the rents. But this is what you do to add value to storage. We increase rents to market. We train our staff better to have a better service, but also to sell better to our customers. We develop community partnerships like with the chamber and other organizations that help promote your company. And then we add ancillary revenues through tenant insurance and retail sales. So we actually get a revenue from all the tenant insurance that we sell at the property. We do a revenue split. We did about $1.7 million of accelerated depreciation. And I have a really fun update to this. So If you've ever invested in a syndication or invested in real estate, just any real estate in general, we do bonus depreciation, and that's going away after this year. But what's cool is we paid $6 million for the property, but we had a $1.7 million loss that went to our investors in the first year. So in 2019, they didn't pay any taxes, and they had so much loss they didn't pay any taxes in 2020. And when we added on those additional units, they opened in 2021. We are getting this year just shy of another $1 million of depreciation based on the asset or based on the units that we added onto the property. So I kind of overlooked that when I was, talking to investors about this opportunity, which was, hey, yeah, you get bonus depreciation in the first year, but when you add on to a property, you're also going to get depreciation when you open the doors to rent those units when they get their certificate of occupancy. So literally, there's been about just shy of a $3 million tax shield on this investment, almost 50% of the original purchase price. Really, really cool stuff. So this is just kind of an example, K1. This is from 2019, the year that we bought the property. This is a $50,000 investor taking about a $21,000 loss. And that's due to bonus depreciation, which again starts to get reduced after 2022. So about 21,000 per 50K investor was lost. Per 50K invested was lost. So how'd it do? How's it going? Where are we at today? So we had a business plan. We talked about raising rents and building additional units. We proposed increasing rents about $72,000 a year. Right now, we've actually increased rents about $205,000 per year in rental increases. And then we said we were going to add 20,000 square feet, but we actually ended up building 40,000 square feet. So that's going to increase our projected NOI $300,000 per year. And then if you remember, at the beginning of the slide, we had that in-place NOI that started. So when we put together our underwriting, we said, okay, we're gonna increase that NOI from 443 to 670 by increasing rents and adding onto the property. And at a 6.6% cap rate, the facility is worth about $10.2 million. And what's actually happened is we've increased NOI to $948,000, which would value the facility at a $14.4 million at a 6.6 cap rate. And what's funny is 6.6 cap rate doesn't exist anymore. Now it's dialed down to like a 5 or even slightly below 5, which would significantly increase the value based on a lower cap rate. So just some things that we do at Spartan. This is actually on our website. Happy to pass it to Kurt and the team at Quest. We do a property due diligence. Whenever we buy a facility, we put it through a 700 due diligence checklist. And these are just some of the things that we look at. We look at zoning, title, appraisal. We go to the physical site. We do a property inspection. We do a geotechnical study. We do a survey to get the title exemptions reduced. And we actually put this on our website. So you can go to spartan-investors.com. There's the checklist is on our main page. You can download our due diligence checklist to use on acquiring your own properties or just kind of for your own education. And, this is our kind of some of the things that we do at Spartan for our investors. We do property tours, monthly updates, quarterly conference calls, and then we send out financials every quarter. And we do property tours around the country. We've done them in Seattle, Madison, Wisconsin, Georgia, Florida. We've done one in Tennessee, and I think we have one upcoming in Texas pretty soon. This is our website, and I've left a little bit of time for questions.
All right, Ryan. Awesome stuff as always. Questions? Yes, we have several. I'm going to start with one here, and being an IRA specialist at Quest Trust, I could answer this one with a very high level. But if you invest with Spartan with retirement money, would it be subject to UBIT? So I'm more than happy to answer that question as an IRA specialist.
Yeah, take it. Yeah,
it depends.
No problem.
It depends. When we're talking about a debt leveraged asset, be clear that you know the distinction between unrelated business income tax and unrelated debt financed income. If we're investing in a property like Spartan, what they have, and there's debt on it, then potentially my IRA could pay UDFI. So this is where you really want to have a good CPA, a good accountant who is not only familiar with IRAs and IRA investments, but in particular, the IRA investment that potentially brings on taxation, because there are ways to mitigate it. There are ways, frankly, to make that UDFI tax completely go away. Contact us at Quest. We can have that discussion in much more in depth because, again, we don't give tax, legal, or investment advice.
Yeah, so I'll just, the only thing I'll add to that is, you know, I'm not a tax, legal, or financial advisor. Do your own due diligence and you know, consult your own team. But with that out of the way, you know, friendly advice. You know, typically our investors don't, and they find a lot of workarounds to it with working with their CPAs. I'll also mention too that you still get a K1 as a trust, you know, as a Quest trust company investor. So you're still going to get the depreciable loss that goes against any potential tax gains, you know, in the hold period. So you're still going to benefit from those kind of losses and avoid paying UBTI, at least during the hold period. When we sell, that might be a little bit different, but I personally use my IRA to invest. I've never paid UDFI or UBIT tax, and I've seen properties go full cycle in my portfolio. So.
Exactly. So, I mean, for every problem, there's a solution. So, again, contact us at Quest and we can run through those scenarios of what potential solutions to a taxable event inside of your IRA could be. I like this question from Greg. Do you offer investors a debt portion or is it all equity?
Yeah, great question, Greg. We do both. So some investors just like doing debt investing, and we have a program for that. And we have investors. We did a lot of debt investing last year for new acquisitions. This is lower risk debt. This is acquisition debt. It's mostly to keep our capital stack fast. So we'll go into a market and, you know, 30 days due diligence, 5-day close, and, you know, we might not get bank financing in that first 30 days. So our private debt investors will invest in the first position on an acquisition that is, you know, basically 65% loan to cost, and, you know, a good DSCR day one. So it's not like high risk flipping debt or something like that. And then what we do is we work to refinance that out. We pay a point each time an investor goes in. And so what we try to do is we try to cycle that investor's debt 4, 5, 6 times a year, collecting points every single time an investment closes plus monthly interest. So we do the debt side, and then we also have the equity side. And there's a very specific delineation between the debt and equity. And some investors do both. They do a little bit of debt and they do a little bit of equity, you know, because they want to keep that liquidity, you know, because the debt is a 6 month or less note typically. And then they like the 5-year maturity on the equity side, because usually our projections are 5 years. So it's kind of some cash in the debt bucket and the equity bucket.
I think one of those things also kind of comes down to the individual's risk tolerance. And if they want to take a ride on debt, potentially make a lot of money on the long term, or if they're looking for that as the LP, that kind of quicker cash, quicker exit type thing. So awesome that you guys offer both for people.
Absolutely.
Greg had a follow-up question. You're going to be attending the expo in Houston in September.
Heck yeah.
Stay tuned, Greg. We'll be working on that.
Yeah, I got a little bit busy yesterday. Sorry I didn't call you, but yes, I'm in. We're in.
Right, so. There you go. Official announcement. Spartan's going to be here. So you kind of touched on markets that you like: secondary, yep, suburban, tertiary, and for a lot of obvious reasons. But the question that is asked here is the goal for Spartan to be in every single state, and how focused, and, you know, what focus do you have on those specific states and why? So is it national domination, take over everything, or do you want to have really segmented markets?
No, love this question. So it can be summarized in one word. We want to have optionality when we exit. So right now, multiple publicly traded REITs are kind of looking at our portfolio, and they're interested in all the assets that we have today. And what is interesting is, you know, as we grow, you know, our focus is on high growth markets where we can add value to the property and complete our business plan. That's our thesis. High growth. So we want high population growth and high income growth in each market. So I'm from Michigan. I can say this: we don't invest in Michigan. Michigan is generally a declining population state. It is you know, it's kind of same with Ohio and Illinois. We're staying away from the generally net loss population states, and we're focusing on states that have high growth, like Florida, Georgia, Tennessee, Texas, the Pacific Northwest. We don't have, and for us, we're a little bit agnostic to blue and red because we don't have the restrictions that multifamily has with moratoriums and evictions and things like that. So we can invest in places that have high growth, like the greater Seattle area, Puget Sound. We can go to the greater Denver MSA out in the more veteran communities. But we look, like you said, in secondary, tertiary markets, and our goal is to build $1 billion portfolio, and we're looking to sell to a bigger buyer, or break the portfolio up into smaller bite-sized chunks to maybe life cos or smaller investment companies, or maybe hold for the long term and refi. We've actually had several of our properties recapitalized. So one property there in Fort Worth, just a month ago, we bought it, we fixed it up, we leased it up, and we refinanced over 100% of the capital that was invested out of that asset. So the investors got all their money back, plus they're still continuing to collect cash flow. So we're looking for optionality. We target a 5-year hold, but we want the most flexibility and the most options to exit at the best price for our investors. So strategy is to continue buying this year, $400 million in markets that meet that criteria.
Yeah, I think there's so many commonalities between storage and multifamily, storage and apartments. And I think the biggest one is one you highlighted on is, where are people going?
Yes.
And with affordability of single family home, it creates a segment of population that are renters, or that maybe they owned a home and now they want to be a renter. So exactly as you said, where are people going? Because that's where the opportunity is. Because it's amazing when you get into storage and see it, what people will hold on to in good times and bad, and what they're willing to pay in order to keep on to the family heirlooms, those precious things that are passed down from generation to generation. So there's that their heart is a lot more invested in it than I think a lot of other asset classes. I think that's another component of why it makes it a sound investment.
Absolutely.
Good question here. And I think you touch on this as far as recession resistance. We don't ever want to say any kind of investment's recession proof, but things that are proven to be recession resistant. Given the economy recession, how do you account for self-storage customers who cannot pay their rent?
This is an outstanding question. So what we do on each one of our facility feasibility studies is we actually look at the average household income for that specific market. So self-storage is a hyper-local investment. So if you say, hey, Ryan, how's the storage in Denver? It's like, well, it depends. On one side of town, in that hyper 3 mile or 3 mile market, it could be great. On another side of town, in the hyper 3 mile market, it could be really bad. So what we look for is average household income given in a given market. And the heuristic is 2 to 3% of average household income is what people spend on storage. So when we're looking at a business plan, we might see a property and it's 20% below the market in rents. So we're looking around and everybody's full. Everybody has below market rents. We'll look at 2 to 3% of the average household income as kind of the ceiling of where we can go overall with rents. And so we look at that data to make sure that we've got the breathing room to go up in the business plan more than what we've underwritten for that facility. The other thing is mobile home parks and self-storage tend to be the best recipients of a recession, because now you're in a big house, now you're moving into an apartment, you need storage, you're saving money. You lost your house, maybe your mortgage was really expensive, now you're in a smaller apartment, you still have your stuff, so per square foot you're going down in cost, right? Because you can stack a bunch of stuff in your unit. So again, when you decide during a global pandemic to put all your stuff in storage and jump in an RV and hit the road and work from campsites, you're saving money. So when you look at a recession economy, storage is actually a tool to help people reduce their costs in a lot of situations. So we kind of look at it two ways. The industry kind of supports itself in that regard, but we also look at average household incomes when looking at the evolution of a business plan.
Awesome. You and I actually talked about this when we were in Orlando. John has a great question. Is there investment as an equity investor? Is it towards that single acquisition, like with the typical syndicator, or is it going to be put into a fund? Is it put into Spartan in the form of a fund, similar to like a mutual fund?
Yeah, so it's not like a mutual fund. Well, I see what you're saying. Yeah, so we do a fund. So we are going to be launching our first fund in April of 2022, and that fund, if you think of it this way, right? So I just gave a presentation at BEC, Best Ever Conference, and my presentation was on making decisions on investing with syndications, and questions you should be asking and things and ways that you should be looking at things. And my personal opinion is you're never really going to be able to do enough due diligence on the property itself that the syndicator is buying, right? So we do our due diligence. We're on the phone with our attorneys, our property inspectors. We're going to the site. We're going to the public hearings if there's an expansion component. We're talking to our architects and civil engineers, getting their opinions. We're very much in the know on what's happening on a property. But as a passive investor, you can kind of do your cursory look and kind of understand the market and do your own due diligence. But on the property level due diligence, it's going to be very limited. What I encourage people to look at is look at the company. Does the company have the capacity and the ability to make great decisions on what they buy? And what is their investment thesis on what they're buying? So when you're looking at a single asset versus a fund, we've done single asset investing, single storage syndications forever. And just due to the massive scale and how fast we have to move, we've pivoted to a fund. And I think investors are going to like it better because they get a more risk adjusted or more, they spread out their risk and it's less administratively burdened. So you're not putting, you're not investing in 5 deals. You can invest in 1 deal and you still get all 5 anyway. So we look at funds. That's kind of our overarching goal for this year is we do fund, and then but the fund has a specific objective to buy value add self storage, which is all the same stuff that we purchased last year and the year before that.
Awesome. And the questions keep coming in. If I don't get to your question, make sure you reach out to Ryan. Make sure you reach out to the investor relations team at Spartan. Reach out to Ted. Reach out to Lauren. More than happy to get the more in-depth questions. Here's a good one. Any prospects in Austin, Texas?
Not right now. Love Austin. Love that market. It's not the best storage market. I know I said I couldn't generalize, but a lot of overbuilding happened. I think it's all getting absorbed right now, but nothing right now on our radar. No. Perfect. It's tough to find things that we can make work in that market in general. Yeah. But East Texas, Dallas, Houston, oh my God, Houston is just absolutely exploding and is a great market to invest in. So
yeah, recent reports for Houston, 100 people a day moving to Houston around the Houston MSA. So it kind of speaks to those secondary, suburban, tertiary markets as well.
And same with Austin, right? There's a lot of good movement to Austin, but there was a lot of overbuilding of self-storage at a period of time. So it just needs to get absorbed before it comes kind of more investment worthy.
Gotcha.
Yeah.
Do you guys ever offer sites that offer, I'll pull the question up here, indoor RV storage?
So that's interesting.
Going up, what's the outlook on boat and RV storage?
So, I have a disappointing answer. So, I know there's a ton of demand. I know everybody's buying RVs. You can't even get the RVs that you've ordered for a year, and there's backlogs, and people are driving them on the road. And then there's the thesis that once this COVID thing is over, then you're going to have this glut. No one's going to know what to do with all these RVs, and they're going to need to put them in storage, right? And everywhere we go, municipalities are begging us, please, could you build some RV storage? There's so much demand, blah 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 blah. Well, here's a great example of why we don't desire to build it. We will offer it if there's vacant land and no more storage demand on that particular site. And here's why: a 10 by 50 space is what's required to put in an RV, right? And you still have to grade it or pave it or even cover it, right? And you might get $50 to $200 a month for that site. So $5 to $7 per year rents. If you could build it, 5 10 by 10s, you're going to get $100 a month per 10 by 10. So now you're making 5 times almost, or 2 times what you would get as opposed to renting an RV. Then if you go multi-story, you can get even more rent, right? So when we look at highest and best use of the property, storage is the highest and best use to the point where there is enough demand for storage. And any excess land, then we'll do it, kind of secondary to our primary business of self-storage.
Gotcha.
I hope that answers your question. Yeah.
I'm going to ask one more question because, and this is more of a high level one. There's some very specific ones about what's the return on the investment. Do you make money when auctioning off contents in the storage facility? Here's a pro tip. I've done it myself. You go to storagegenie.com and you can bid on it, put it in your garage, sell it on the marketplace. There's a second stream of income. So as an operator, can't speak to that. As a consumer, there's a way to make money doing that.
10-second answer. The answer is we recoup the revenue that we lost when the tenant wasn't paying on any profits from the auction. But above that, we don't profit. It's just we recapture the rent that was lost.
Right.
Yeah.
Awesome. Last question. And again, a lot of this is speculative because of, there's the war going on, the impacts on importing, exporting. A lot of concern right now as it relates to our overall cost of energy, food, gas. Discretionary income is going to be going by the wayside in a lot of cases if worst case scenario happens. So the question from Dave here is the average food bill is expected to increase by $1,000 a month or up to $1,000 a month. How's that going to impact your tenants paying their monthly storage bills, occupant rates, bad debt?
Yeah, no, it's definitely a consideration on any asset class and across anything within the economy, right? I mean, when costs go up and people have less discretionary income, then it can be a big deal. That might mean people shutting down their businesses. That might mean people having to downsize. That might mean people having to move to a cheaper market. And all of those things trigger self-storage events. This isn't something that you do in excess. This is something you do because something happens in life. So, people always ask me, we don't have as much of this in Europe, or we don't have any of this in Europe because Americans just have too much stuff. And they're hoarders and all this other stuff. I disagree to a certain extent. I think that storage is a tool to use when you have something happen to your life that's disruptive. So the more disruption, the better we get. In COVID, we had record rent growth. We had record occupancy growth. It's because there was disruption in the market. People were losing their jobs. People were moving. People were downsizing. And I think that's when you see that decline in GDP over the last 4 recessions. You see occupancy stays rock steady because people are constantly using the space during bad times and during good times.
Well, I think even when we look at in normal times, life events that happen, divorces, people getting older and downsizing, they'll get rid of their house, but they want to hold on to the stuff. And that's where I think that, as you've illustrated perfectly, that storage is a very sound investment in good times, but it can also be a very great investment when it is a quote unquote bad time.
Absolutely.
So, again, guys, if I didn't get to your question, it's not for any other reason than very specific questions like average rate of return, things of that sort. Have that discussion with Ryan and his investor relations team. I mean, I don't want him to be high level with stuff that's very, very in depth. But that's going to wrap it up for us, guys. Ryan, I appreciate you so much for being on here today. It's always great to see you. I've enjoyed spending some time with you over the last couple of weeks, and always learn something myself whenever I'm in your presence. So I appreciate it very much.
Thanks, Kurt. Appreciate everybody.
All right, guys. Again, if you have any questions as it relates to Quest, reach out to us at IRA Specialists at QuestTrust.com. Reach out to Ryan, Spartan, the investor relations team, if you have those in-depth questions about potentially investing with Spartan, what that looks like. Have a great weekend, guys. We're gonna go home now. So thank you again. This has been Self-Directed Saturday with the voice of self-directed education, Quest Trust, and we'll see you all next Saturday. Take care, everyone.
See you guys.